ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. It's Friday. It's time for us to talk a little bit more about swing trading. First of all, before we actually continue with the topic of today, what we found out the last time on Wednesday, we spoke about mainly on the charts, no indicators whatsoever. We saw how with just a simple Fibonacci tool, we could actually determine where in the future our support and resistance levels lie, and of course from where the trend begins, which is pretty much that was the main idea. Now, speaking about the beginning of the trend, it's, as we mentioned the last time, it's very easy to determine once an event has already happened what would be, at the beginning of the trend to the end of it, reversals, so on and so forth. Right now we're still inside a midterm trend, which of course when we drew these lines the last time, we of course saw some better techniques on how to actually determine the continuation of a particular trend. Now, first of all, we're measuring the short period trend, which of course is not relevant to where exactly these lines are pointing, but mostly because at where they're crossing here. Now at the 1240, or roughly 1240.30. So this is from where the trend actually begins to the upside. And as we can see, if we catch the beginning of the trend after the consolidation, the continuation patterns, and of course when we consider our entries, as we spoke the last time, it's much easier when we're using additional indicators. For example, today, when we speak about confirmation of a particular trend, we're going to use the moving average convergence divergence. The main reason we're using this is because it's a delaying indicator. Now, without saying too much about it, we've been all using the MACD for many years. We already know how it functions, what exactly it measures. But most of all, what we need to find is that the default levels, without changing them whatsoever, we can have a very simple, well-built indicator, which is of course, one more time, a delaying indicator. But of course, the correct way to use it is not in a short period of time. Basically, that's why we're sticking with 1 hour charts or 4 hour charts or even daily charts when we talk about swing trading, based on the fact that on every new high, we have an opportunity to enter the market. What I mean a new high, it's where exactly the histogram is crossing back down below the moving average, and one more time, that's making a 2 tips. Okay, basically those 2 tips are pretty much to the reversals or the retracements of the market, which is exactly what we need. A delaying indicator means that first of all, when the price is gaining, okay, the price in this case, but let's say when we have a price action, okay, like this one, it's nowhere to be seen here on the histogram of the MACD. But with the progress that the market is making, as high as we go, these particular cases where we're saying it's a formation 1, 2, 3, this is because you have one strong hike, a second strong hike, and a third one, which is usually smaller than any previous one. So you can see that the market hike is stronger at the beginning, relatively weaker in the middle, and much more weaker at the end. when the market reverses, and of course it touches the trend line, and the crossover of these short trend line, the long-term trend line as well, and we can determine from where the market will start bouncing up. Or we can also use Fibonacci levels like these here, which you see on the right. Mostly I would start entering, as we mentioned the last time. It's not yet a confirmed trend because we still have to see the 100% retracement from the previous downturn trend, and we can see that downward trends are much more quicker than the upward trends. It's very easy, the price of something to decline with a short period of time instead of building up on, let's say, a price of gold could be more expensive for a longer period of time, but of course weaker in a very relatively shorter period of time. So that's why we are always happy to wait a little bit more so we can have much better confirmation. Actually, the way that the whole system functions is that it allows you to enter relatively soon, and this is only if you track the continuation or reversal patterns. Let me clear everything out so you can clearly see it. This is a morning star formation. This is the beginning of your opportunity to trade. The moment this candlestick opens, you open a long position, and you can see immediately basically you're getting inside of a profit, which is imperative, especially for swing trading, because that means you have caught the right moment. And this is on the retracement, and this particular pit here, that it's showing a retracement, but then the price starts growing. Some people, of course, some traders could consider entering after the whole market move have retraced until 23.6% on the Fibonacci. That means that would be here. I would prefer, to rely on the swing highs. Let me just zoom it in. It's going to be much better for you to see those particular hikes. Okay, I think we were here. Okay, like this. This is the case we're talking about here, the morning star formation. We have, it's barely visible, but in some cases it will be much bigger. Okay, like this case, for example, here. You have a big one here. So these peaks and troughs that you see here are much more visible on a much steadier trend like this one. That's 45-degree trend, and it's continuous. That's basically downward channel. Okay, what you see here is a 1, 2, 3 pattern, or ABC, some call it, but it's an actual 1, 2, 3 pattern. Now, when we have the pattern occurring, that means that this is the end of your first trading opportunity. When you have these peaks, there's one here and one over here. I'm pretty certain that it's very difficult for you to kind of imagine why it's happening, or let's say even see it if you haven't dealt with it already. But as you can see, this histogram here is much smaller. Okay, this bar here, let me just point it straight for you. This bar is relatively lower than the other two. You can see the height of this one and the height of this one. It's much higher than this one, which gives you the idea that somewhere in the midst of these whole bunch of candlesticks is the one that you should consider entering. Of course, I would always prefer to see the whole pattern occurring and a much more stronger candlestick formation like this one, and of course the trout, from where of course we are going to expect another move to the upside. And when the second one occurs, we start to see the drop of volatility. Okay, it's increasing here, it's increasing here, but on the final trade here, it's already exhausted. So therefore, the peak here is much lower than the previous peak, which gives you the 1, 2, 3 pattern, the 3 hills that are concluded. So at the moment you see the crossover of the moving average, you consider exiting your trades. That's somewhere in the midst of these groups of candlesticks. You don't have to wait for too long to book these profits. Now I'm telling you why. Because of the fact that the MACD is a delaying indicator. Okay, we should act very soon when you see this particular pattern, or if you see the possible head and shoulders formation here, or right now it actually validated as a double top right now. But then we cannot really enter it because it's not yet confirmed. We still don't have the histogram in the negative side of the market. Now I'm going to tell you why. It's very important for you to wait for as long as it's necessary so you can enter, because the pattern is developed throughout time. It can develop in 1 day, it could develop in 3 days, or in 1 week. Now from now we're waiting for relatively longer than that. It's been since what? Since last Friday, which we had that nice move up. It was until here, if I'm not mistaken, throughout the Asian session, where on Tuesday we made a second top, and right now the market is testing the neckline of the double top formation here, which you see it's exactly at 1282. If we measure with Fibonacci on different occasions, previous trends, you will see that this particular level is very strong. It's very important for gold prices to either sustain gains or keep falling down. Okay. Now, when we speak about the histogram, we need to see these peaks developing. Okay. On the third one, it's usually going to be exhausted. As you can see, one hill, second one, very sharp bars, but then the next one breaks down, a third one, and somewhere here you exit your position. If it's a long one, that would have meant that it's somewhere in the break of this trend line, which is relatively around a bunch of these candlesticks here. This is the moment where the 1282 area is broken, but it's not yet confirmed. So right now the market could end up inside above this trade, invalidating this pattern, okay, and keep climbing. That, of course, will need some significant volume to do so, but it's not, it's not impossible. It's also something that could happen. But the more likely case scenario is for the market to move to the downside, because we saw the volatility exhausting for the past few days. There is zero activity here on the histogram. You can see just basically flicker dots on it, nothing else. But of course, and we see the bouncing market between a very, very tight range from here to here. That's 78 to 81, 82. It's very tight range, especially for gold. Also, when we spoke about booking profits immediately after the trend is over, we already see that the trend is over, or at least stopping for a while. So the one thing that you will not be able to do is to make money during the sideways direction. You will either have your past positions still, but the market won't be moving, and basically you're not making and you're not losing any money. It's the same thing as booking your profits. It's actually lower risk to take the profits out, for a very simple reason. We have a strong double top formation on a relatively very long run up. Okay, for the first time it actually tested the 1282 area. Initially it was looking as a head and shoulders formation. This is one shoulder, this is the other one, and this is the head. And then of course it actually confirmed as a larger double top formation, or a triple top, you can also say that, if you're counting this one, but it doesn't really matter. It's not so important as to how many tops you're you're counting it's the fact that you have to exit. So the one turn here, let's get back to our case scenario, where we saw a huge opportunity, a continuation pattern. It's an uptrend exactly on a supportive level as 50 retracement on the Fibonacci. A possible 1 to 3 formation. I'll tell you why. You will find out very easy in the future to find out that it's a possible 1 to 3, because it's in 99% cases there are always 3 moves. When it starts like this, huge volume candles, consolidation, huge volume candles, consolidation, and the same one, and it actually ends on the last one. So you have one lot here, for example. Okay, you take your profits here, or just half of it. You can just leave half a lot for the possible next move up, which of course comes here. This is also another lot. I would of course consider leaving smaller amount than one lot, like let's say 0.3 or something like that. Okay, 1/3 of the position would remain, 2/3 will go away, and I'll book the profits, because the sooner I get money out of a trade, I can reinvest it in something else. Or for example, if it's already running profit and the market is going to decline, I'm going to take the profit here, and then I'm going to book 1 or 1.5 lot, because we're getting closer and closer to the exhaustion of the trend itself. So the longer it continues, the faster it will actually it will end. I mean, let me rephrase. The longer it continues means we don't really know if it's going to stop here. It could continue 3 times the size of it right now. But the fact that it keeps going and going and going makes the reverse of the trend more aggressive, which means if I have one lot here and I decide to keep all my positions, that would be very risky, because I'm not booking any profits. I'm just running these profits. Okay, if the market aggressively reverses overnight, for example, if I'm not following the market, basically you can't really stay up all. I mean, it's not possible to never sleep and always follow the market, or just for some reason, to wake up early in the morning, just check your positions. That's really exhausting. It's a lot of stress. You don't need that. Of course, you have your stop losses, but you will do everything to avoid hitting those stop losses, and that comes when you book your profits accordingly, the right way. Okay. Now you booked some of your profits here, and then 1.5 lot, you open another position here. On the next run, I'm going to close 1 full lot and just leave half of it, or I could even close 1.2 lots and leave 0.3. The fact that I would choose to leave a higher amount of lots here is the same reason that I left less over here, because with the progressive way of the trend, okay, the way that it goes, it's less likely for this position to be hit when the market is here, but it's more likely to be hit when it's here. That's why you've already left as little as possible, so you can continue making money. Basically, you should not throw away your time for nothing. So you have no idea if the trend could continue from here or from here, okay? But the fact that you've already made quite a bit of money, you have some backup, some support on the previous profits you have from here, and they're still running. You're closely watching these candlesticks, whether they're going to confirm below the trend, somewhere on the trend line, from where, of course, you will actually start terminating profits gradually, the way we talked about the last time on Wednesday. And of course, when the trend reaches its absolute maximum and its reversal pattern, or a reversal signal by a double top formation like this one, or a head and shoulders, or even whatever it is, it doesn't really matter. The case is that you always have to terminate everything here, because even if the market continues, now what the market needs to find out whether it's going to go up is to break above these levels. That's a very long way to go. That's close to 1300. Now, once the market breaks above these levels, then you know that it's also a psychological level of 1300, which allows you to receive even more support if the market starts closing up above the 1300. So not only that you have to be watching at the peaks and troughs on the MACD, or your trading trend lines, or continuation or reversal patterns, you always have to know also the nature of the instrument that you're trading. There are psychological levels on everything. Gold, oil. For oil is $50. The weekly pivot point is at 52. So for the euro, 1.1, for example, is also a psychological level against the dollar. Round numbers are usually very important, major numbers, not only because they're not round numbers, but basically because of the algorithmic trading. We're in era of high technology. Computers are, basically taking the opportunity to trade instead of man. I wouldn't really risk my future to leave it in the hands of a computer, for a very simple reason. They die, they crash. It's a robot. It's not that we are machines as human beings, but the fact that you can better rely on yourself than in someone else, that means that your money is much safer in your own hands. And of course, whatever that you do with them is right now up to the experience that you gain. And for a very simple reason, you can't really make the computer to learn the things that you do. So you have to teach it. And for that, of course, takes coding, time, writing skills, so on and so forth. For that, of course, also needs knowledge. And why would you let somebody else take the fame, for example? It's much better to make the money on your own without using any machines. But that's me. Probably some could call me, old-fashioned or whatever. I mean, I'm still trading on electronic platform as well. I'm not doing paper contracts on Wall Street, but the fact that it's much easier access and it saves you time and headache, ear pain or whatever from screaming on the floor, that would also account for the peace of mind the human being could actually have when he controls everything. Well, ladies and gentlemen, nothing complicated about this addition to our home system. I could, of course, show you further examples of the way that behavior of the swing trading type. First of all, that would be much better for you to do, because if you are willing to use this particular system for your swing trading, that of course will need a lot of practice. You will need to get familiar with the style of trading, to find patterns on the market, and so on and so forth. So you see, we can't really trade only on a candlestick chart with patterns. Okay, it's okay, you can do it. But the fact that you can use some tools in a MetaTrader 4, and on top of that, not complicate too much your chart with useless trading indicators that most traders actually don't even know what they're measuring with these. Okay, they're read somewhere in internet that it's very good to use commodity channel index with commodities. It makes logic because it's made for commodities, but the fact that you can apply it anywhere, like it's also good for currency pairs. In that connection, commodities, there are commodity currencies. All of this, a trader should know what he's using before start using it. And on top of that, you need practice with it, so you can train your eyes on what's to come. And basically, the idea of the trader is to predict the future market moves. To do so, you need reliable instruments. Okay, reliable instruments are mostly delaying indicators, larger time frames, swing trading, and along with that, with patterns that we showed today. There are a lot of them on the chart. Of course, when you see it in present time in an active trade, it's probably going to be in the beginning very difficult for you to believe that the market is going to go the way that the indicators are telling you, or for example, the way that the chart pattern is showing you, or the candlestick formation. But it's imperative when we talk about swing trading. We're looking at a mid-term chart. We're not focusing, and we don't really care about short-term trades. Now, recently, until not yesterday or the day before, when the market reached this point here, I've been holding gold positions for 2 weeks. Okay, of course, everyone is paying swap rates. Everyone is paying taxes, to trade on the platform, everything like this. But the substantial gains that you do actually eliminate all problems around these taxes, $7 per lot, for example, or the interbank rate. That's also something that you will not care in the future, because it's already calculated. At the end of the profit is your own profit, and of course you have the detailed report on what your position is doing. All of this, when you, ladies and gentlemen, start thinking about the trade and about trading like a profession, then you will understand how crucial it is for you to be extremely sharp when you're working. That is why you have to be protected. You have to have the peace of mind. Speaking of which, I'm not going to discuss ways of stop losses. Okay, I'll tell you why. It's very easy to see here that you will always set up. For example, if you're entered here, it's imperative to understand that you will always set your stop loss somewhere around here. Of course, that's a very big one. That's $5. $5 stop loss. That's of course equal to $500 on a lot. Okay, that's a lot of that's a big loss. But the fact that you are trading for a long period of time, and you can allow yourself to open one lot here, 1.5 here, 2 lots or 3 lots here, and even keep all positions open for the full, say here, that's $60. Okay, $60 on one lot, that's $6,000. Well, it's nice to have to know exactly how much money you would have made, but to make it, to do it, that's another matter. And we're talking in a matter of it's about a month time exactly. We see 21st of March, and today is 21st of April. So it's 1 month since this trend developed. That is why it's so imperative that you catch it from the beginning to the end. It's very important because, ladies and gentlemen, this is your profit throughout your whole month. Okay? This is everything that is feeding you, bringing food on the table, taking your kids to school or kindergarten, buying your wife's, expensive stuff, or with regards to the ladies here, I would always say when there's a woman in this business and she's making money, she doesn't really need a husband because she's already gonna do it on her own, and the bling bling that she's gonna get will be on her all well earned money. Well, the one thing that we've learned here is that if you're trading one instrument or 2 instruments, for example, because when you catch that trend, you are not going to focus in another currency pair or a commodity. You will always learn, study, read, be always with the news, geopolitical tensions, whatever it is moving the market. You always stay with it. But when another opportunity comes, of course, when the market tells you now it's time for you to book your profits, okay, this is when you have to be ready and to do it. Because the next time you might end up in a loss, or the whole profit that you've been looking for throughout the month, you would have already lost half of it, which of course is a very sad thing. Honestly, it is. I mean, you've done so well, you've been learning for so long, you've been reading all around, you've been collecting information from whatever you can collect for what would be the next market move. Speaking about gold prices, for example, on the fundamental side, of course, because you're following a trend. There's nothing else for you to do. You just need to know when to add more to your positions, like here, or here. Okay, these are the things that you have to follow. So one lot here, one lot here, one lot here, and here. Let's say you've done 5 lots until the end. Well, that's pretty good profit. $6,000 here. What we have here from here to here, we have $50. That means 5,000. Here, $4,600, and another 40 or $4,300. So you see 5 positions, each and every one in average is making you about $5,000. That's pretty good. That's pretty good money for 1 month, I say. And of course, you can allow yourself to not be greedy or risky the next month, because the next month you will probably have an opportunity even bigger than that, or none whatsoever, or not even one. For a very simple reason, the market could be stuck in a sideways direction for a long time. You see this? That range, but you already have that support. You have that lot here. Okay, that's giving you a certainty that you're on the right track. If the market is moving against you, okay, you will say that's okay. That's not a 1, 2, 3 formation, or that's just something else. I was wrong. But that's $500 of stop loss against 25,000 or even 30,000, depending on how you actually build up your portfolio on this one. Anyways, that's all, ladies and gentlemen, for today. I'm going to get the next thing ready for next week. Of course, we have a lot more interesting thing to come until we conclude our final webinar on Friday next week. This is when we will find out the whole picture. Okay, the whole picture of the system. Until then, whatever questions you might have, you can just call us here at the office, or drop us an email at webinar@gdmfx.com, or just come to our website, gdmfx.com. There is a pop-up chat on the bottom right corner. Our colleagues over there will be very kind to share whatever information you require, or whatever problems you might have. They will ultimately right away deliver a message to one of my colleagues or me personally for whatever issue that you might have. That's all about it. Thank you very much for joining me. I'll see you next week on Wednesday, same time. Okay, see you then. Bye-bye.